again to another episode on REITs by REITspro.com. And today the topic is Budget 2023 and what the impact of that is on REITs and InvITs. In case you are not familiar with REITs and InvITs, please do go to our website. You can pause here and see what REITs and InvITs are, and you can connect with us from our site on these two ways, or you can even email us. So what really happened in the budget 2023? Well, what happened was that the REIT prices fell and the investors sold REIT stocks soon after budget, and this was a clipping of the press and says that post-tax return of REIT unit holders to be hit from budget proposals and to tax income earned in debt repayment. This is what happened. This is what happened. And the second thing, that the REIT companies reacted this way because of such a large price drop, and to comfort investors, was that there was a statement by a REIT and it talks about that the announcement impacts about 40% of our current distributions, and this is what they have. You can pause here and read the statement as well. But still, the crash of markets happened, REIT stocks in the markets happened, and Embassy REIT was down from 340 to 300 rupees approximately. This is the graph here. Even Mindspace and Brookfield REITs were down. There were impact on InvITs also, but there were lesser, but the trends were overall weak for InvITs. So why did this happen is what we would talk about today. Why did this happen? So a substantial portion of the earnings that a REIT distributes was now proposed to be taxed, and this was not so earlier. And investors, like we all know, buy REITs and InvITs for stable rent or revenue generation. Now the price crash happened because now any investor now would pay lesser for an instrument if the net returns become lesser. So the impact of the budget was that the net returns that happened became lesser. We've elaborated that with Embassy REIT and IRB examples. But now essentially, if you had an investment of 100 rupees and earlier 10 rupees was being given per annum, 8 rupees on that would be probably typically tax free, and 2 rupees would be taxed. Now in this proposal, what happens is that out of these 10 rupees, 4 rupees becomes tax free and 6 rupees is taxed. So the net returns that comes in the hands of the unit holder becomes lesser because of the taxation impact. And that is why the prices crashed. And if you remember, in our earlier video on 3rd November 22, we'd also talked about this is one of the risks of REITs. So we talked about legislation and taxation rules becoming unfavorable, which could impact the REIT prices. Similarly, in another video in July, we'd also elaborated that this is an ambiguity. This portion that we're talking about right now, this was an ambiguity since a very long time. So the return of capital, would it lower the acquisition cost or not? And there were two opinions of two different consultants for two different REITs. So there was an ambiguity here. You can pause here and watch the earlier video also. And this ambiguity is probably what has been addressed and made this whole scenario change today. So the tax-free components of REITs and InvITs are like this. So this is, if you see the interest part, that's taxable. Dividend is tax-free if there is no concessional tax at SPV level. And the third one is the repayment of debt. Let's try to break down that slide with the help of an example of IRB InvIT and Embassy REIT. On the left side, where here I have the IRB InvIT Q2 distributions, and this Q2 distribution, 1 rupee 25 paise was interest, which was taxable, and 80 paise was the return of capital. So earlier the tax was 1 rupee 25 paise, and now it's expected, after the budget, it is expected that the tax would be 2.05 on 2.05 as per investors tax slab. Similarly, Embassy was earlier being taxed at only 86 paise out of a total distribution of 5.46 rupees in Q2. Now if this example is replicated in today's scenario, the repayment of debt portion of 2 rupees 40 paise will be added to 86 paise, and we would have 3.26, which would be taxed as per investors tax slab. So obviously the net amount per unit that the investor would get would fall. And to make things clearer, I am sharing a snapshot of the memorandum explaining the provisions on the Finance Bill 2023 here. And the heading which I have shared here is tax avoidance through distribution by business trust to its unit holders. So this is what the memorandum starts with for this section of REITs. And it says that it has been noticed that business trusts give in these forms, 4 forms. It distributes the incomes, and there it says that the first 3 categories are already taxed. However, the 4th category, which is repayment of debt, does not suffer taxation in the hands of business trust or in the hands of unit holders both. So it's tantamount to saying that it basically gets it escapes taxation at any point. So now there is a small caution for the viewers here. It gets a little more technical after here, and only if you're decently familiar with REITs or an existing investor, you'll be able to relate to the following slides more. You can always go back to our earlier videos. You can visit our site reitspro.com, and you can see the resources which are like historical returns, blogs, books, and so on to get more familiar. However, let's carry on with the presentation here. And further to the snapshot which I just shared last, the 7th and the 8th point also talk about that this dual non-taxation of distribution was not the intent of any special taxation regime that was applicable to business trusts. So now they propose to make some such sums received by the unit holder taxable. So now further on we'll talk about this question here, that is it really avoiding tax or is it taxing it twice? So as you see here on the left side, you have the structure of a REIT, typical structure, simplified structure of a REIT in India. So in the center you see REIT here. The REIT invests in SPVs via both equity and debt. So that's the downward flow of money, and the SPV, when it gets rents, it gives upwardly that money is distributed as dividend, interest, and amortization, etc. Now here the term cash flows and not earnings is important, and we'll just to ignore nomenclature, just understand it as cash flows here first. So this is the actual example, this is the actual snapshot of Brookfield REIT, and this is a small part of that structure, a small window from that structure. So there is an asset SPV beneath, and on that they have a asset. So now how does this asset SPV pass rent to REIT is what we will just have a it's a very simplified version, and in fact, you know, you can read the note below, and there are other things also which are nuances, but let's talk about the very basic elementary thing here. So let's say 100 rupees is the rent given that the SPV generates from the asset. Now the interest given on that is 50 rupees, let's assume. So 100 minus 50, then 50 remains. On this, let's say the SPV pays tax at 30%, so 15 rupees goes out of 50 and 35 remains. And then as per company laws, seeing the earnings and several other things, only a certain amount of dividend is paid. So the balance amount 15 is then the amount that the SPV gives as amortization of loan back to the REIT. So here if you look at it, the repayment of debt is actually it's not a part of SPV P&L. So this is it's really tax, so because only the interest portion gets the tax benefit. That's what one of the main things that one can probably understand it. And the memorandum again to the finance bill, I'm coming to that again. So the unit holder in that case also was not taxed. The amount which was given out as dividend was not taxed at the unit holder level if the SPV paid full taxes, and it was not being taxed at the concessional rate. So the fact that what is stated here, that this has been accorded and they are taxable in the hands of unit holder is not true in this case of dividends. And my last comment on this snapshot of the memorandum of the memo, the finance bill, is that it says clearly that repayment of debt is actually an income in unit holders' hands which does not suffer taxation at any time. But if, as we've just talked about it, should unit holders be taxed if there is no concession rate at SPV level is the question, because it represents non-cash tax deductive elements of SPV, for example depreciation. So that's where the cash comes from. So that's and that's where what is distributed, but either you're taxing that or it's double taxation. But definitely there is some kind of a ambiguity in this, which would probably be cleared over some time, or we would these are some points to think about, which I would share with you, and then you can probably share with us on our comment section. But at the same time, the tax regime is what it is, and we have to take what it is given and act accordingly. So what are your views? There is a WhatsApp group in the description of this video only, and you can click on that and join our WhatsApp group and discuss with other people also what you feel about it. And if you've not subscribed to a video, please do, and I will just take you through to the points that you can probably ponder over and think about. So number one is the loan principal repayment is not tax deductible. That's the first part. The loan principal repayment is not tax deductible. Secondly, should it be given the same status as dividend, the loan amortization or repayment, because there is no tax to unit holder if taxed fully at SPV level in case of dividends. Third, can loan repayment be called redemption? So these are the 3 points, and you can always connect with us, or you can mail us also at this ID. Thank you so much for watching.